Different methods of retail Forex trading. Currency futures involve contracts to buy or sell a currency at a specified price on a future date, providing a transparent and regulated market. Currency options grant buyers the right but not the obligation to buy or sell a currency at a set price by the option's expiration. Currency ETFs offer exposure to single or multiple currencies through managed funds, allowing traders to speculate, diversify, or hedge without individual trades. Spot FX operates 24/5, directly connecting buyers and sellers. However, most retail traders use Forex brokers who add markups to prices from the primary market. Retail Forex trading allows traders to control large positions relative to their margin. Trades don't result in physical currency exchange. Instead, they are rolled over daily. Spread betting is a derivative product where traders speculate on currency pair price movements. Forex CFDs are agreements to exchange currency price differences between opening and closing positions, and they offer the opportunity to trade both long and short. These methods enable individuals to participate in the global Forex market, each with its advantages and limitations.